for a long time, Bitcoin was the fastest horse, really, that you could invest in. It was kind of the best performer. And the rise of AI companies has challenged that because there are other places to put capital. I think, Bitcoin in the 60 plus thousand range is cheap. I don't necessarily have a bullish 3 or 6 month view. I'm not bearish on it in that time frame, but I can't really tell you what it's going to do in, say, a 3 to 6 month period. But looking back 5 years from now, I think that the 60s is an attractive, buying range.
What is your 360 now analysis of Bitcoin's performance in the last year, and where do you see it headed?
Well, the short answer is, Bitcoin has this volatile track record. It has higher highs and higher lows along the way, but it has these really big washouts. Historically, it's pretty correlated with liquidity. At least 83% of the time, it's correlated with kind of overall kind of macro liquidity. About 17% of the time, it's not. Right now, it's kind of in a period where it's not. In addition, for a long time, Bitcoin was the fastest horse, really, that you could invest in. It was kind of the best performer. And the rise of AI companies has challenged that because there are other places to put capital. That can give you a 10x return, or that have given investors a 10x return. And so people say, well, why would I hold Bitcoin when I can, hold a chip stock or something like that? And of course, the advantage of Bitcoin is that it gives you what a stock does not, which is that you can self-custody it like gold. And with advantages or disadvantages versus gold. Gold's obviously got the longer term track record. The challenge, of course, is that it's not as mobile. Without relying on custody. I use the example that I live part of the year in the U.S. I live part of the year in Egypt. If I have self-custodial gold, there's going to be a time where I travel and it's out of my personal possession at that point. Whereas you can set up Bitcoin in a multi-signature way so that if you travel the world, you still have ways to access self-custodial value that you can send around. And so there is a use case there. But I think from a price standpoint, from a pure investor standpoint of just buying it and holding it and not really using it, when people can buy, Bitcoin treasury companies, they can buy Bitcoin ETFs, they can buy Bitcoin on exchange. They're comparing that price action to AI, and I think the rise of AI is kind of sucking a lot of the attention out of it. Now, eventually, when that stops rising, like we talked before, when that kind of just say trend sideways for a period of time, and Bitcoin is washed out, I think it can reattract some of that capital. The other big factor is that I've been bearish on the broad crypto space for many years. I've been bullish on Bitcoin and stablecoins, but bearish on virtually every other project in the space. And a lot of that is really shaking out now. There's right now, just kind of the overall use case of broad crypto is very stagnant. I think a lot of investors are kind of realizing there's no there. And a lot of that capital is intertwined. So as capital gets out of that broad crypto space, it naturally, in the near term, hurts Bitcoin as well. But I think when the dust kind of shakes out, Bitcoin and stablecoins, there's actually a there. And it's natural for kind of some of the air to come out of that broader crypto space. And it's healthy in the long run, even though it can be kind of painful in the near term. I don't think the 4-year cycle is really functionally relevant anymore. It still, I think, has some kind of mental relevance in that people, if people expect something, they can kind of be a self-fulfilling prophecy. But I think for the past cycle or two, it's not really mattered. So earlier on, the 4-year cycle was really relevant because you had less coins in the market, you had more coins coming out with each block, and so a halving. That's what happens every 4 years, roughly a halving. So there's just half as many coins being introduced into the market per block. That really matters. If you have a monetary network with, say, a 12% supply inflation rate, and it gets cut to 6%, that's a really big deal. But after multiple halvings, Bitcoin now has a supply, like annual percentage supply growth of less than 1%. And the vast majority of kind of marginal buying and selling of coins, prices are mostly set by how much longer term holders are selling and at what prices versus how much new demand's coming in. That factor is 10 times bigger than how many coins are hitting the market with every block, just because that number is so small now. So when you have say a 0.8% annual supply growth, and you know eventually have a halving, you cut that down to 0.4%. That's less relevant than is 5% of long-term held coins coming to market because the owners are concentrated and they want to kind of cash out. That's a much bigger factor than the havoc. So I don't really view the 4-year cycle as relevant. I still think liquidity is still relevant. I think the performance of precious metals and AI are relevant because obviously precious metals compete with Bitcoin on kind of the hard money front. So if those are rising a ton, it challenges Bitcoin in terms of competition. But then also tech stocks kind of challenge Bitcoin because Bitcoin is tech to some degree. So when you have kind of that fastest horse being AI, that also challenges Bitcoin. But at the end of the day, it's I think the 4-year cycle is less relevant, and it's really just about the usefulness of the network and the network effects that the system still has.
Which are the assets that you see have more upside potential now in the coming quarters by the end of this year?
Silver had a big price run, so I still hold silver, but I'm less bullish on silver at higher prices than I was at lower prices. I'm still bullish on Latin American financials. I do think that as we enter this ongoing U.S. fiscal dominance, the emerging markets that have dollar liabilities will generally get an uplift from their weakening dollar liabilities. Many of them, like for example Brazil, their central bank has been very hawkish, really really high real rates. And I think eventually they'll be able to reduce those and kind of benefit Brazil's economy in the process. And just in general, there's like a lot of the foreign capital is just not there anymore. It's gradually been coming back a little bit because those things are not underperforming the way that they were throughout the 2010s and the early 2020s. But they're at this kind of inflection point where it's funny, during the 2025 year, the year of kind of trade wars, if you went up to most people and said, you know what, one of the best performing assets this year was Colombian and Brazilian banks. Like nobody would have guessed that, but it's just basically they were left for dead. Global capital had totally come out, and now just by not going out anymore and just around the margins a little bit coming back in, it's kind of booming. And just like we talked about how bubbles can kind of occasionally form. I mean, sometimes these things will do so well in a given 6 months or a given year that they need a breather from time to time. But I still think the multi-year runway for, say, Latin American financials and certain emerging market equities in general has a pretty long runway ahead for many years. There's obviously there's geopolitical risk, there's domestic risk, but I think that there is a lot of opportunity in those names. I think Bitcoin in the 60,000+ range is cheap. I don't necessarily have a bullish 3 or 6 month view. I'm not bearish on it in that time frame, but I can't really tell you what it's going to do in say a 3 to 6 month period. But looking back 5 years from now, I think that the 60s is an attractive buying range. I think that while gold got ahead of itself, I don't think it got overvalued. So gold's in a consolidation. I think eventually it probably consolidates for quite a while, but then breaks up rather than down. I'm still bullish on energy companies in general. Even again, I mean, if you get an announcement tomorrow, hey, the Straits open, we have total peace in the Middle East, and energy flows again, then sure, energy stocks probably don't have a great year. But I still view them as an important part of a portfolio because you have these fortress balance sheets that make money, and they will often move in a different way than many other equities, which is valuable for a portfolio. And so I do expect decent performance out of them, especially when you include dividends that they pay over a multi-year time frame. And so, yeah, I think there's plenty of opportunities out there. Not everything's a bubble. Some things are cheap. It's generally things that have some risk. But when you have a handful of pockets of those, I mean, if 3 out of 5 or 4 out of 5 work out and 1 or 2 out of 5 don't work out, you've at least spread your risk out accordingly. Yeah, well, I mean, silver did tremendously over the past year, but because mining stocks and everything did so well, I'm less bullish going forward. It's not that I'm bearish. It's just that I view the asymmetry is gone, meaning that when silver was like $18 an ounce, but then even when it was in the high 20s or 30 an ounce, it's like there's not much downside really, but it's like it could easily triple, right? And that's the kind of numbers that we got. And when gold was under 2,000 an ounce, it's like I can't really like like there's not really any strong reason for why it could go lower meaningfully, but there's nothing stopping it from doubling or tripling. But as you get that doubling or tripling, or depending on which metal we're talking about, it's a little bit more of like it's less asymmetric. Like I wouldn't be shocked by a 30% drawdown in silver, nor would I be surprised by another 50% increase in silver. It's just that it's more of that kind of volatile trading range where I feel like I have less of a conviction on what it's going to do in a given, say, 3-year period. And same thing for mining stocks. I generally, at the moment, I'm leaving those markets for others. I'm still a long-term holder of gold, silver, and platinum. But I'm less kind of viewing them as a trading opportunity per se.
Hey, I am Maria with DailyDoseCrypto. Have you noticed that gold, silver, and Bitcoin have hit all-time highs recently? Is this a coincidence, or are smart investors onto something? The dollar is depreciating, inflation is eating up all of our cash, and the US national debt is through the roof, hitting new highs every day. That's why people are shifting to alternative assets like gold, silver, and Bitcoin. We at Daily Dose Crypto have partnered with iTrust Capital, your one-stop platform to buy and securely store 80+ digital assets, including Bitcoin, gold, and silver to hedge your future against debasement. With over 200,000 accounts, 15 billion in transactions, and 11,000 plus positive reviews, they're helping real investors build long-term wealth with their tax advantage, IRA, and PCA, which is a premium custody account that supports the highest level of custody and security in the space. They do this all with institutional-grade custody through partners like Fidelity Digital, Fireblocks, and Coinbase Prime, keeping your assets secure while you can trade 24/7. Fees are just 1% per transactions with no monthly or annual costs. Getting started is simple. Sign up for free and fund an IRA or PCA today. You'll receive a $100 bonus and start growing your assets the smart way. Click the link below to open your account now and begin your journey toward generational wealth.
One is that a lot of times you'll see headlines like the Treasury seizes crypto, and people are like, look, they seized Bitcoin. And it's like, well, no, they said crypto. So a lot of times, I mean, that's kind of the risk of stable coins, is that especially stable coins can just be, they're a centralized issuer. So you can just go to the centralized issuer and say, hey, freeze these tokens. We've identified that these are held by Iran or North Korea or whatever, and they can be frozen. Bitcoin, while it, around the margins, it can be taken. I mean, if you find a way to get someone's private keys, if someone stores their private keys online, or you're able to enter their place and take them, you can seize Bitcoin. But much like seizing a nation's gold or an individual's gold, there's a cost of doing that, either war in terms of a country, or arrest or intrusion as far as an individual. And so without the private keys, you can't get someone's Bitcoin. And some of the headlines, I think, confuse that for some people that aren't kind of just well versed on how the cryptography works and how the system works. And there is a difference between how Bitcoin, potentially can be seized versus how stablecoins and certain other cryptos can be seized. There was some evidence that Iran did turn to Bitcoin payments. The question is once they get the payments, what can they do with the Bitcoin? They can't just go on to Coinbase and say, hey, we're Iran. We want to go ahead and sell our Bitcoin for dollars. That's where that off ramp runs into issues. Now, Bitcoin is a global market, and it's not just like it's not like a stock where it might trade primarily on one exchange. Bitcoin is this decentralized thing that can trade on multiple exchanges. There are gradual ways that Iran can offload, their Bitcoin for other types of value, but there are frictions with it. Generally speaking, the bigger the network gets and the more trading hubs there are for it, the easier it gets to offload it, right? So the less kind of dollar-centric it becomes, it'd be easier for regimes like that to offload it. But at the current time, I mean, I think that they have to be mindful of size, that they can offload some, but they can't just, get any amount of Bitcoin that they can and then just turn around and get dollars or yuan or gold for it easily.
What is, let's say, the thing that markets are ignoring that keeps you more worried, let's say?
Well, in the near term, I would say that the market is still underpricing the Strait of Hormuz crisis. I think the market's kind of gotten to its head that, wait, there wasn't like a major energy crisis yet per se, so that then it means it's not going to happen. But of course, the world is drawing down on strategic stocks to kind of keep the wheels in the cart. There has been around the margins some demand destruction. Some of the data out of China is opaque. We don't know what other kind of refined products reserves they might have that aren't reported that have drawn down. And if this goes on long enough, there's a stage where that energy is still not getting out to the world, but the major stockpiles have already drawn down, and it can't really keep drawing down anywhere near the rate that they have. That would be concerning. You could get an energy price spike, and then you could get impairments on corporate margins, impairments on consumer spending. Because of that, you could have certain developing countries run into more acute shortages. I mean, in Egypt, for example, throughout April, they had an energy curfew. They were fortunately able to lift it throughout May and here into June. But there's a chance that something like that would have to come back, and other countries would have to do that. And again, that's if we're months from now that this is still all closed and this is still an issue, which is maybe it'll be resolved, maybe it won't be. So I think that's still a somewhat underpriced risk, that the market's just kind of calm about it. But other than that, I mean, I think that the scenario of kind of fiscal countries running it hot fiscally is very much in play, which is equities do better than you think in currency terms, but generally do pretty poorly in gold terms. And that's been the case we're seeing at. So you see people talk about record low consumer sentiment in the US with record S&P 500. And they say, well, where's that disconnect coming from? And well, I mean, if you look at many emerging markets when they have a crisis, stocks are doing pretty well in local currency terms, usually, even as they're doing poorly in dollar or gold terms. And the US is kind of in emerging market light. And so is Japan, and so are parts of Europe, which is, when a developed country enters fiscal dominance, they get some kind of characteristics of an emerging market. And so it's not surprising that, in this period of kind of structural currency debasement, many of them have decent equity markets, but poorly in kind of hard money terms. I'm bullish on stablecoins. I've been bullish since several years ago. The market cap was like 30 billion, and now it's 300 billion round numbers. And I think eventually that they'll get into the over a trillion, maybe eventually into the multiple trillions. So I think that there's a lot of demand there. The ironic thing is that the U.S. doesn't really have to do much. They just have to not stop it. So the U.S. could, if they wanted to, kill most dollar stablecoins by saying, hey, if you issue a stablecoin, you're sanctioned. We don't want stablecoins. So they could do that, but simply by not doing that, there's a growth of stablecoin demand that is pretty organic. If you kind of look at the world, I mean, Africa has something like 40 currencies. Latin America has something like 30 currencies. There's plenty of currencies in Southeast Asia. All of these are frictions. All of these are border frictions. And stablecoins are a very efficient way to transmit value and to hold short-term value, assuming you're not a sanctioned entity, assuming you're not in Iran or North Korea, where the U.S. and the stablecoin issuers can shut you off from it. If you're just someone in Argentina or someone in Nigeria or someone in Malaysia, they're a very effective tool to access a less inflationary currency than generally their local currency, and to pretty seamlessly store and transmit near-term value. It does get debased over time. You're basically holding dollars without yield. So you're holding something that the supply of it is growing by 7% a year, and you're not getting paid. The stablecoin issuer is getting paid. I think that, again, we have to keep numbers in mind. So if we go from, let's say, 300 billion in market cap to 1.3 trillion, so let's say we add a trillion in market cap, that'll take time. And that's 6 months of U.S. deficits. That's 6 months of Treasury issuance. So the sheer numbers of how many treasuries are out there, how many treasuries are going to continue coming to market versus stablecoin demand, It's a relevant factor, but it's not as though it's a magic fix for the fiscal dominance that the U.S. finds itself in. And the major cost is that people that choose to hold stablecoins for more than just working capital are getting debased. I mean, again, they're holding something that grows in supply by, dollars grow by 7% a year on average, and they're not getting paid a yield in the way that if they held treasuries directly. And of course, they're not holding something that's kind of dilution resistant like gold or Bitcoin or high quality equities or real estate. Switchover happened last year, where gold, overtook treasuries. The reason it's getting a little bit of renewed headlines is because the ECB says it. So when an official source says it, it gets kind of renewed interest among kind of the public that watches that. And I do think it's a really relevant trend because for a long time, gold was the primary reserve asset. Really starting from the treasuries and onward, the treasury became kind of the major kind of reserve asset. And it really kind of peaked in, say, the 2000s. You had kind of the UK infamously dumping some of its gold at the bottom. And so the combination of poor price performance of gold and just diminishing tonnage held by central banks while they were holding more and more treasuries, that was kind of the peak of treasuries versus gold. And really since then, especially since 2009, there's been this gradual shift back toward central banks are gradually increasing their tonnage of gold. And when you have combine that with price increases of gold, doing way, way better than treasuries, that combination of higher tonnage and price has made it so that gold is now a larger reserve asset than treasuries once again for the first time in quite a while. And I think that's a durable trend. I think it's going to continue to be the case, and I think over time it'll even grind higher and kind of reassert itself as a kind of a dominant reserve asset. As far as kind of reserve currency status, the tricky thing there is, although it's labeled reserve asset, it kind of refers to central bank reserves. There's really kind of four major functions of a reserve currency, at least as we kind of modern think of them. So one is as that reserve asset. Another one is that it serves as the most liquid trading pair for most currencies. So when you have over 100 currencies in the world, the number of combinations between any given currency, there's just countless combinations, and most of those are not liquid. So if you want to exchange Egyptian pounds for Korean won, there's not really a liquid market for that. And so what you generally do is you trade one currency for the dollar, and you trade the dollar for that other currency. So it kind of serves as the bridge for almost every other trading pair, except for a handful of others that might have liquidity. It's basically it's on one side of the transaction for 90% of exchange transactions. That's another really big use case. Another big one is cross-border funding. So if a company in Brazil wants to borrow money, they can sometimes borrow in their local currency, but many emerging markets, there's a limit to how much they can borrow in their own currency from, say, foreign investors. They might want just a sounder ledger, so they'll lend in dollars, and that's that kind of cross-border debt and that cross-border financing activity is another key function of the reserve currency status, and that's still with the dollar. That's not with gold. And then the fourth one would be unit of account. So energy contracts and just in general international contracts are often priced and defined in dollars as kind of just the most liquid shared ledger for international relations to happen in. And so all of that is a powerful intertwined network effect that I think is going to persist for quite a while. Even as gold starts, kind of reasserting itself as the kind of the primary, reserve asset again, something that stores its value better than the treasury, especially as we enter this ongoing fiscal dominance. You get more and more treasury debasement and dollar debasement, while gold is still pretty supply constrained. Of course, the other tricky thing is that the dollar, while it's not really kind of rising in prominence anymore, it is around the margins eating into the euro's market. So it's like the euro is underperforming the dollar in terms of kind of globalizing itself as an asset. And so you have on one hand gold taking market share from the dollar as a reserve holding, but the dollar is still kind of holding up because it's beating up like its weaker competition, which in this case is the euro. So I mean it depends on which factor you look at. All those different functions of the dollar that I mentioned, I think most of them are going to keep persisting for quite a while, even as the store of value function is increasingly gold.
Look, you don't have time. Don't miss out this 2025 bull run. Educate yourself first ahead of the crowd. We have created the ultimate step-by-step crypto cheat guide that will guide you this bull run. Unlock the secrets of crypto and make smarter investments today. Now by clicking on the link below to get your exclusive copy just under $10.